The stock market can be intimidating for beginners, but don't let that fear stop you from building wealth. Investing in stocks is one of the most powerful ways to grow your money over time. When you buy stock, you're buying a piece of ownership in a company. As the company grows and profits, so does the value of your stock. Investing in the stock market is a journey, not a get-rich-quick scheme. It requires patience, research, and a long-term perspective. But the potential rewards are significant. By investing in stocks, you can participate in the growth of the economy and build a more secure financial future. Remember, investing always involves some risk. The value of stocks can go down as well as up. But over the long term, the stock market has consistently trended upwards. Start your investment journey today. Take the time to learn the basics, develop a sound strategy, and watch your money grow. Ready to dive into the world of stock trading? Your first step is to open a brokerage account. Think of a brokerage account like your gateway to the stock market. It's a platform that allows you to buy and sell stocks, bonds, and other investments. Choosing the right brokerage account is important. Consider factors like trading fees, account minimums, research tools, and customer support. Some popular online brokerages include Fidelity, Schwab, and TD Ameritrade. Opening a brokerage account is usually a quick and easy process. You'll need to provide some basic personal information, such as your social security number and employment status. Once your account is open, you can start depositing funds and placing trades. Remember, opening a brokerage account is just the first step. It's important to do your research, understand the risks involved, and invest wisely. Now that you have your brokerage account set up, it's time to fund it and start buying stocks. Depositing funds is typically straightforward. You can link your bank account or transfer money directly from your checking or savings account. Once your account is funded, you can start placing orders to buy stocks. When you buy a stock, you're essentially buying a small piece of ownership in that company. The price of a stock is determined by supply and demand. The more people want to buy a stock, the higher the price will go. There are two main types of orders you can place: market orders and limit orders. A market order is an order to buy or sell a stock at the best available price. A limit order, on the other hand, is an order to buy or sell a stock at a specific price or better. Understanding the different types of orders is essential for successful stock trading. Choose the order type that aligns best with your investment goals and risk tolerance. Before you hit that buy button, it's crucial to research the stocks you're interested in. Don't just rely on tips or rumors. Take the time to understand the companies behind the stocks. Start by looking at a company's financial statements. These statements provide valuable insights into a company's revenue, profits, and debt levels. You can find this information on the company's website or through financial websites like Yahoo Finance or Google Finance. Next, consider the company's industry and competitive landscape. Is the company operating in a growing industry? Does it have a strong competitive advantage? These factors can significantly impact a company's long-term prospects. Remember, investing in stocks involves risk. Past performance is not necessarily indicative of future results. By conducting thorough research, you can make more informed investment decisions and increase your chances of success. Section 5. Mastering the art market orders versus limit orders. When you're ready to buy or sell a stock, you have two primary order types at your disposal: market orders and limit orders. Each has its own uses and implications for your trading strategy. Market orders. A market order is an instruction to buy or sell a stock immediately at the best available price. It's the simplest and fastest way to execute a trade. However, keep in mind that the price you get might be different from the price you saw just moments before placing the order, especially in fast-moving markets. Limit orders. A limit order allows you to set a specific price at which you're willing to buy or sell a stock. This gives you more control over the price you get. However, there's no guarantee that your order will be filled if the stock price doesn't reach your limit price. Understanding the difference between market and limit orders is crucial for effective trading. Market orders are generally suitable when you want to buy or sell a stock quickly, while limit orders are more appropriate when you have a specific target price in mind. Section 6. The art of timing. Knowing when to sell your stocks. Knowing when to sell your stocks is just as important as knowing when to buy. Holding on to a stock for too long can be just as detrimental as selling too early. There are several reasons why you might consider selling a stock. If a company you've invested in is no longer performing well, or if its future prospects have dimmed, it might be time to cut your losses. Similarly, if a stock has appreciated significantly and reached your target price, selling can lock in your profits. Remember that emotions can cloud judgment, especially when it comes to investing. Don't let fear or greed dictate your decisions. Have a clear investment plan in place and stick to it. Review your portfolio regularly and make adjustments as needed. Section 7. Dividend Delights, unlocking a stream of passive income. While many investors focus on capital appreciation, the increase in a stock's price, dividends offer an attractive way to generate passive income from your investments. A dividend is a portion of a company's profits that it distributes to its shareholders. Companies that are profitable and have a history of sharing those profits with their shareholders are known as dividend-paying stocks. Investing in dividend stocks can provide a steady stream of income that you can use to supplement your regular income, reinvest in other stocks, or simply enjoy. Many retirees rely on dividends to fund their living expenses in retirement. When evaluating dividend stocks, it's important to look beyond just the dividend yield. Consider the company's financial health, dividend payout ratio, and growth prospects. A sustainable dividend is one that is well supported by the company's earnings and has the potential to grow over time. Section 8. Dividend Deep Dive. Key metrics for stock selection. When it comes to choosing dividend stocks, certain metrics can help you identify potentially profitable investments. These metrics provide insights into a company's dividend-paying capacity and the sustainability of its dividends. Dividend yield. This metric tells you how much dividend income you can expect to receive for every dollar you invest in the stock. It's calculated by dividing the annual dividend per share by the current stock price. Payout ratio. The payout ratio indicates the percentage of a company's earnings that it pays out as dividends. A high payout ratio might signal that the company is distributing a large portion of its profits, potentially leaving less room for future dividend growth or reinvestment in the business. Growth rate. Look for companies with a history of consistently growing their dividends. A steadily increasing dividend payout often reflects a company's commitment to returning value to shareholders. Understanding these key metrics can help you make more informed decisions when selecting dividend stocks for your portfolio. Remember that diversification is key. Don't put all your eggs in one basket. Section 9. Financial Fortress, assessing dividend stock stability. While a high dividend yield might seem enticing, it's essential to assess the financial stability of the underlying company. A company with shaky financials might not be able to sustain its dividend payments over the long term. Start by examining the company's balance sheet. Look for a healthy debt-to-equity ratio, which indicates that the company is not overly reliant on debt financing. A strong balance sheet provides a cushion for the company to weather economic downturns. Next, analyze the company's cash flow statement. Focus on free cash flow, the cash flow remaining after a company has covered its operating expenses and capital expenditures. Consistent and growing free cash flow is crucial for a company's ability to pay dividends. Finally, consider the company's industry and its competitive position within that industry. Is the company operating in a cyclical or defensive industry? Does it have a sustainable competitive advantage? By thoroughly analyzing a company's financial health, you can gain confidence in its ability to maintain and potentially grow its dividend payments over time. Section 10. Diversification, spreading your investments for stability. Diversification is a fundamental principle of investing that can help mitigate risk and enhance potential returns. It simply means not putting all your eggs in one basket. When you diversify your portfolio, you spread your investments across different asset classes, industries, and geographies. This reduces the impact that the poor performance of any single investment can have on your overall portfolio. For example, instead of investing all your money in a single stock, you might consider investing in a mix of stocks, bonds, real estate, and other assets. Within stocks, you can further diversify by investing in companies of different sizes, sectors, and geographic locations. Remember that diversification does not guarantee profits or eliminate the risk of loss. However, it can help you manage risk more effectively and potentially enhance your long-term investment returns. Section 11. The long game patience and discipline in stock trading. Investing in the stock market is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. Don't get caught up in the hype or try to time the market. Short-term market fluctuations are normal. Instead, focus on building a diversified portfolio of quality investments that align with your financial goals. One strategy that can help you stay disciplined is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market conditions. By investing consistently, you can ride out market volatility and potentially benefit from buying more shares when prices are low. Remember, investing always involves some degree of risk. There are no guarantees in the stock market, but by following these tips, you can increase your chances of success and build a brighter financial future.
What I wish I knew at 10 instead of 30 is that fun has no age limit. Welcome to our channel, your one-stop destination for all things entertaining. From engaging children's education videos to heart-pounding adult suspense thrillers and everything in between. We've got dynamic, dramatic entertainment that will keep you on the edge of your seat. So why wait? Hit that subscribe button, like our videos, share with friends, and drop a comment to let us know what you think. And don't forget to tap that notification bell so you never miss an update. Join us on this roller coaster ride of fun and thrills. You'll be glad you did. Stay tuned because there's so much more to come. Just wait and see. Let's have a great time together. See you in the next video. We're waiting just for you to come back again. So stay with us all the way.